Okay. All right, recording now. So we started chapter 11 on Friday, and I want to give us a little bit of time on that. We will squeeze in a break as well. So, all right. And on Friday, we talked about dividends, and we talked about, and you guys recorded some transactions on page 80. We started on page 79 in the course pack. And we kind of wrote down definitions. And we have cash dividends and we have dividends payable. All right. And then over on either on page 80 or on page 83, we recorded the transactions on Friday. So we had 3 important dates: a declaration date, a record date, and a payment date. And we said we have to have all 3 of those, and if we don't, the stockholder, so the company says, we've got money, we're going to pay a dividend, they declare a dividend. At that point, in that point, the company books a journal entry. So in this case, it was 100,000 shares. They declare a 30-cent per share cash dividend. That's usually how dividends are recognized. How much per share? So the company declared a dividend. You guys recorded this on Friday. Debit cash dividend. If you didn't record it on Friday, feel free to record it now. So get out your course packs, and I'd like you to write down these journal entries. We are on page 79. And we might have already recorded this. If not, record it now. So we have debit cash dividends, credit dividend payable. Now, we haven't used the language cash dividends before. We've just used dividends. But we're differentiating because in a little bit, we're going to talk about stock dividends. We were here, and then I said, let's log our journal entry here, and we've got all these. Here we go, right there. Okay, dividends payable. You might have had it over. Keep going. We were picking up these journal entries, and then I said, go ahead and look them anywhere on these pages. So you can log that right here. Okay. Okay. Let's see, these were definitions, and then page 80. That's why I did a new handout. So then let's open here. Let's log this right here. Okay. Yeah. What page is that, Cole? So put it on page 83, yeah, if you didn't have a chance to log this on Friday. Okay. Debit cash dividends, credit dividends payable. In the past, we've said the company pays dividends, we've debited dividends and credited cash. But in fact, there's a timing issue here. There are 3 dates. Company at this point, they recognize the liability. So if they went for a loan, after they did this would increase their liabilities, which, as we know, the more liabilities you have, typically your loan interest rate goes up because the bank or whoever says you're more risk, okay? And the way the dividends are announced is we announce a dividend to stockholders of record on whatever the record date is, in this case, December 29th. Okay. To be paid January 20th. These are actual dates for PACCAR. And I, as an employee of PACCAR years ago, I used to think this was really stingy of PACCAR to announce a dividend way back December 15th, but not pay it until January 20th. And I don't really think that was the reason. I mean, companies are very cash conscious, but I think it just takes time to roll out a dividend. Okay. So, dividend is declared, liability is acknowledged. At the end end of the year, cash dividends, it's closed. We know that, right? Retained earnings, revenue, expense, dividends, those all get closed, but not retained earnings. They'll get closed to retained earnings. Stockholders of record is whoever owns the stock on December 29th gets the dividend. If they sell their stock after December 29th, it doesn't matter, they get the dividend, okay? So between the 15th and the 29th, the value of that stock will go up at least 30 cents because there's a dividend invested. Whoever buys that stock between the 15th and 29th will be receiving the dividend. All right, on the December 29th, and note that this are in your notes, note this was the declaration date. In your notes, you wouldn't do a journal entry, but I would recommend you write it down. December 29th, record date, no entry, okay? December 29th, record date, no entry. And then finally, the payment date, we're just clearing out the dividend payable. So what's that gonna look like? Getting rid of dividend payable. How do we do that? Debit dividend payable and credit what? Cash, yeah. We're just paying the dividend. And I feel like we had conversation about this on Friday, did we? If you have PACCAR stock, do you get a check from PACCAR? Not usually. Usually you don't have the stock sheet, the stock form, certificate. Usually you have an investment account. It's all electronic. So you tell your broker or whoever's managing your account, I want that dividend to go into cash, or you tell your broker, I want you to buy more PACCAR stock with it. Just turn it around and buy more stock. Okay. But from the company's point of view, this is exactly what happens. So write down January 20th, dividends payable and cash. Okay. So debit, dividends payable, credit cash. This happens from the company point of view. What your broker does with that is could be a different thing. They could be putting it into your cash account. They could be reinvesting it. Okay. Which means it'll jump into the cash account and jump out again when they buy more stock. Okay. Great. Okay. That's common stock, but preferred stock is a different ballgame. And this is where we get into those percents that are attached to the description of the preferred stock account. Preferred shareholders, like those people at the front of the plane, more leg room, drinks, real silverware, all that. They get dividends before common shareholders, and it's a percent calculation based on a percent of par value. And typically par value is $100 per share. Okay. Goes with me. So now we say cumulative dividend. So the next, where we left off on Friday was we had a cumulative dividend feature. So the preferred shareholders, the preferred stock is listed as cumulative or non-cumulative. Non-cumulative doesn't matter. Cumulative is where it gets a little more, there's a few more calculations. So keep in mind, this is not a loan. Even though we're using a percent on the preferred stock, it's not a loan, but it starts to feel like one when we get into cumulative stock, okay? So what it's saying is, if preferred shareholder stock is cumulative, their dividends have to be paid first. If there's no money to pay the dividends in the current year, in the next year, you have to pay double to cover the missed year and the current year. So it starts to feel like a huge liability if you have not paid dividends for a while as a company. In fact, there is some argument that says, hey, if you're reading the financial statement, those cumulative preferred dividends are nowhere to be seen unless you dig into the notes and say, oh, look, the preferred stock is cumulative and they haven't paid dividends in 10 years. That company has a potential liability. Okay. Of course, the board of directors could always say, we're not going to declare a dividend ever. But that doesn't go over well with the stockholders. Okay. So how do we calculate dividends? Part I is $100 typically, and the percent is listed. So 10%, $100 would be $10 per share. That is so different from how we look at common stock. All right, so let's look at the handout. I think I've caught up to the handout here. So on December 31st, Rosales has 1,000 shares of outstanding 9% $100 par value stock, cumulative stock. So real quick, fill in the blanks there. How much is the preferred dividend per share? I said rate there. Please cross off the word rate. It's dollars. Let's see if we can do this. And just cross out rate, because rate would be the 9%. So it's how many dollars per share. Okay. So real quick, what is it? Per share of preferred stock. If there's money for dividends, how much will go for each share? Here. Yes, you do. Multiply. Keep going. The 9% is correct. 9% per share. Auto. $9. 9% times $100 face par value. So it's going to be $9 per share. Okay. So write that down if you take notes. Okay. And then if they have enough money to pay all the preferred shareholders dividends, what's the total dollar amount that they're going to be paying? You would, yeah. And remember, it has to be outstanding. We're assuming it's out. Well, I've told you it's outstanding. So it's going to be 9,000 not per share, but 9,000 total. Again, if they have the money to pay. Okay. All right. So now, oh yes, they also have common stock. They have 50,000 shares of common stock outstanding. On December 31st, the directors declare a $6,000 cash dividend. Write down what is the journal entry for the declaration of that dividend. I just had it on the board. What's the journal entry? The board of directors just declared the dividend. They have to make a journal entry. What is the journal entry? Correct. How much? Say it again.
If you say cash,
Say it louder, Cole, please.
Is it 6,000?
Correct, but say the whole journal entry.
Oh, cash dividends and dividends payable.
Cash dividends, dividends payable. So again, fairly straightforward, and it's going to be 12/31/2011, cash dividends, dividends payable. And it is 6,000 because that is all the money they have for dividends. And I don't know why the columns debit and credit are not equal with. Okay, I was in a hurry this weekend. All right. Yeah, Bryce.
So for stock, after you get $9 a share, you'll get 6,000.
No, they pay what they can.
So
They pay 2/3 of the dividend. And I can't even use the language owed because it's stock and it's not debt. But in a sense, it's owed, right? They paid 6,000, even though the preferred dividends are, if there's enough money, they should have gotten 9,000, but there wasn't. So on your chart here, oh, who received these dividends? That's the question. Who got the 6,000 bucks? Preferred or common or both? Just the preferred. They're in the front of the plane. If there's only enough Coke and coffee and wine and beer for the first class, that's who gets it. The people in the back don't get any. Yeah, right.
So preferred stock percentages aren't like a guarantee, they're just half how much you get paid out.
The preferred stock is not a guarantee. They're just a what?
Half on how much you get paid
Yes.
out. So
And they're the terms of the stock. If we have enough dividends, you'll get $9 a share.
but a company could just say we have $6,000 left over, let's invest it back into machinery. So
Exactly. They're not required to, but because this is cumulative, the next year, they'll have to pay the 9 they missed and then the additional 9 for the new year, if they declare dividends.
so they can push it down the road, it's never paid.
They could keep kicking the can down the road and never pay dividends. But we know what happens. Stockholders get really mad. And then they make a coalition and then they vote the directors out and put directors in that are good.
Like public stock board going at 25%.
Right.
They don't have any power with that, right?
Correct. But they can form coalitions. So
So
just like any other change, right?
there's $3,000 left over of the, for stockholders.
3,000 was unpaid.
If next year another 9,000 comes in, now we're at 12,000, and they declare, each declare 12,000, or do they do like 6,000?
They can do whatever they want, but anything unpaid goes into arrears. And that term sounds like owed. It just means whenever there's dividends, preferred gets their portion first, their 9,000 a year first, if there's money, and any amount that's in arrears before the common shareholders get any money. So look here on the chart. You don't have to do anything here. So this basically says, in the year 2011, the company declared 6,000 in dividends. The company paid 6,000 to preferred. There wasn't any dividends in arrears at the beginning of 2011. Okay, and that is why this is 0. So there was nothing, and then there was nothing left to pay the common stockholders. Now we're going to go into 2012, and 2012 has automatically that 3,000 in arrears for preferred. Okay, but this is where we left off on Friday. Yeah,
Is $60,000 a typo?
no,
Where's the,
where's the 60?
yeah,
Oh, no, this is the next year. Okay, so now we come to the next year. This was the current year. Now we're going into a new year. Okay. And my question to you on Friday is, in 2012, they declare a $60,000 dividend. How will you apportion that between preferred and common? How much do preferred get? How much do common get? So take 2 minutes and talk to people around you and see how you're going to allocate that. You got 6,000 to give out. No, this is the new year. The new year is 60. The old year was 6.
So is it, appropriate to say the dividends are paid when they, do they have specific, if they only afford 6,000 this time, then that's what they should.
Next year, 2012. And now we don't have 6, we have a whole 60,000 dollars.
What's the percentage for
Preferred.
Yeah.
I would prefer to take care of Right, and the rest goes, if there is any left. Well, yeah, preferred has to be settled before anything goes to common stock. But I doubt that they give the majority of the cash to common stock.
So just to clarify, this 2011 is for reference. We're just saying you got 60,000, how much for preferred, how much for common here? You're not doing anything in the 2011 column. You're just saying, here you go, Micah, 60,000. How much to preferred, how much to common?
And they still have the same amount. For shares of- So 500,000. So it's like common stock.
It's got to add up for 60. How much are you giving to preferred and how much are you giving to common?
3,000.
So in other words, whatever you give to preferred, common is whatever.
Dividends declared, allocated, declared. Yes. 500,000. Common stock, so 3,000 carried over and so 9,000. No, 50,000 shares, $10 are now outstanding. That was at the top. That's what they owe for common stock. They never did anything with it. They just paid preferred.
Yeah.
What? 3,000 is the carryover value from the previous year.
But I'd like us to bring up all the calendar
I have one correct answer so far. Anybody else? If there's money to pay dividends, how much in a normal year would prefer to get? So what I'm saying is you've got 60,000 to allocate. So put that here. Okay. How much to preferred, how much to common? Got 60,000 that was declared. And we're just working with 2012. How much does the preferred shareholder get? How much does the preferred shareholders get? We got 60,000 to allocate. How much does the preferred shareholders get? How much does the common shareholder get? And we know we had 3,000 in arrears. So for, and then have to get that number. So it's not 9, it's that.
Okay.
Makes sense? Okay. All right. So we knew we had 3,000 in arrears. Normally, we'll pay 9,000. So the preferred shareholders get 12,000. How much will the common shareholders get? Yeah,
How much of those?
for common,
Yeah, 500,000.
0.
Yeah.
So the difference, so what Cole just asked is how much is owed the common shareholders? Nothing. They are at the whim of the board of directors of the company. If there's a dividend, they get a portion. Yeah, Chase. Sure. So last year we had, I can find it. Yeah. Last year we said on December 31st, 2011, the directors declared a $6,000 cash dividend. So we only had 6,000 to give out last year. And because we had preferred stock, they get theirs first. If there's enough money for the preferred stockholders, they each get $9 a share. But we only paid 6,000. Because the preferred stock was cumulative, that 3,000 unpaid goes into arrears, which means the next time there's dividends, if there's enough money, you get your normal dividend plus anything in arrears. Could be 1 year, 2 year, 3 years of arrears. Does that make sense?
They only take care of the preferred stock.
Ooh. So really, they only take care of the preferred stock?
Well, there's no incentive.
So these guys get 9. Okay. There is an incentive to, okay. There is an incentive to always keep your stockholders happy. Because if your stockholders are unhappy, they can file a class action lawsuit. They can band together what we call a coalition of stockholders. Granted, there might be a few institutional investors who don't want to play, but institutional investors want dividends too. So they can all get band together and vote out the board of directors. So they do have some power. I mean, that's the common shareholders just have the vote. Okay. All right, next page. What's the journal entry for the 60,000? You have 30 seconds to write that down. All right, guys got it? Who's got it?
Are they paying it or declaring?
Declaration. Right. All right. I'm going to push the break out a few minutes because I want to go into the, give you some team time. Okay.
So you'll have to split dividends payable between all that.
You can, You can create two accounts, dividends payable common, dividends payable preferred. We just simplify it here. So this is what we just did on your handout. Okay. All right, they declare a dividend, everything goes in arrears. And then there's the, all right. All right, I want to talk about stock dividends. It's a little bit like printing money, stock dividends. So what companies do is, remember, they have authorized shares, issued shares, and outstanding shares, so depending on whether they bought any treasury stock. What a company can do is give their stockholders a stock dividend. If you own 40 shares in the company, and this is very low numbers, if you own 40 shares in a company and the company has 160 shares outstanding, you have a 25% ownership position in that company, 40 out of 160. If a company issues a stock dividend, your ownership has to stay the same. So they can't change your ownership. And that's a really important thing. You don't want to lose your ownership position. You should not lose your ownership position. So in this case, the company went from 160 shares to 480. So it was basically, and then they turned around and kept the ownership position. So if you had 40 shares before and that represented 25% after you got your stock dividend, that would be 120. All right. Why in the world would anybody want to do stock dividends? I gave you a little bit of space here to take notes, if you like to take notes. To satisfy stockholders' dividend expectations without spending any money. So this is where I get into the, we used to joke that if you worked for a startup company, they'd give you stock certificates, and you could, the value of them was you could paper your walls with stock certificates, but they really have no value unless the company starts appreciating. Yeah.
So what's the difference between a stock dividend and a split?
In the case of a stock dividend, they're actually increasing the number of shares outstanding, and they are, the splits, they're just changing the par value and increasing the number of shares. Okay. So the stock dividend, the par value is the same. So satisfy dividend expectations, increase the marketability of the corporation's stock, and to show that we're permanently reinvesting in the business. You're actually pulling money out of retained earnings when you do a stock dividend. You're transferring money. So remember back to our original dividend journal entry, we debit dividends and credit cash, and we close dividends to retained earnings. We also close stock dividends to retained earnings. We don't do that with stock. We don't touch retained earnings. Okay. So, all right. So let's do a quick journal entry. So we're not going to do large stock dividends here. We're going to do small ones. And so we record a stock dividend at fair market value, which is basically your market price. And that's if you're less than 20 or 25%. If you do a very large stock dividend, then it impacts par value. Okay. Okay, so at the middle of the page, you've got Voth Corporation has 60,000 shares issued and outstanding. The par value is $10 per share and market value is $15 per share. Okay. They declare a 10% stock dividend. Okay. So I want you to write that math down. So make sure, or see the math that's written down for you. Okay. So remember, we're going to show the first journal entry is the declaration date. I'm not going to, there's no journal entry for the record date. And then we're going to show the payment date. So if you, this is, we've got a new account here to look at. And that's the last new account that's listed on page 79. So we've got stock dividends. We've got I don't think I gave you a date. Did I not? No, I didn't. Okay, we'll leave the date up. So we've got. Pardon? No, it's a horrible account. I'm sorry. It is a long one.
That much.
I mean, you could do CS div distributable. That you could do.
Where did you get the 6,000 from? The common stock dividend?
Hang on just a sec. Let me write this down. Paid in capital. Okay. So they have 60,000 shares outstanding. Okay, and we declared a 10% stock dividend. So 60,000 times 10% is 6,000 shares that they're going to issue. We're going to use market price of 50. But then here, this journal entry should feel vaguely familiar to you. Okay. It's a little bit like selling stock the first time. Only in that case, we debit cash, credit common stock, credit paid capital, additional paid capital. We're declaring a 6,000 dividend, which is a par value of 60,000. And then we have 6,000 again times $5, which is the additional paid capital. Okay. So this guy is 90. How did we get the 90,000? We took the stock dividend times the market price. This is 6,000 times. This is 6,000 times 5. How do we get the 6,000? 60,000 shares times 10%. So why does this satisfy the market? It's that because in this case we've got a market price that means the stock is actually trading. But when you declare a stock dividend, just the same way you declare a stock split, the market price is going to adjust to market. Yeah.
So common stock percentage always goes off of market rate, and then the preferred stock goes off of par value.
Percent for what?
So like you said, there's a 10% dividend, and you're going that you're paying it off the market value. Right?
So the 10% is calculated on the shares. So we had 60, now we're going to have 66,000 out there outstanding.
But that's going off the market value, not the par value, right?
The stock dividend amount is based on market value.
But for preferred stock, whenever you do dividends, it's based on par value.
Correct. Correct. Yeah. That's just another example. Okay, so here's our first example. Now, again, this is, make a note here, this funny account, common stock dividend distributable, is a temporary account. It's similar to dividend payable. And then when the payment date, we clear out the common stock dividend distributable and credit common stock. So add that one to your list.
We go back to that. Or copy it down.
Okay, hang on. we're gonna say common stock dividend distributable and common stock. Is that okay, or you want me to go back to the slide?
Oh, no, that's fine.
Okay.
I just didn't know if you're gonna.
Yeah, no. So remember, declaration, payment date. So if you close the books and publish financial statements between those two dates, under stockholders' equity, you'd have common stock, and then you'd also show common stock dividend distributable. Okay. Everybody good? Okay, I'm gonna go back. So stock dividends, just like cash dividends, are close to retained earnings at the end of the year or the end of the month. Okay. And that's different from stock splits. Stock splits don't touch retained earnings. And at the bottom of your page, you see this graph before the dividend, after the dividend. You can see the total is still 890,000, but we have more outstanding shares. All right. And remember, it's a small dividend, so it doesn't affect par value. All right, last thing, and I'm just going to touch on this, and then we're going to give you some team time. Go to your next page. What is a stock split? Stock splits reduce the market value of shares. There is no journal entry for stock splits, but they do increase par value and increase number of shares. Okay. So let's go back to the balance sheet here and say, what if instead of doing a stock dividend, we did a stock split? Okay. So here it is, the before picture. We had, and this is at the bottom of your page here, so, or top of your page here, sorry. We had 60,000 shares of $10 par value common stock. I didn't even put preferred in here just to make the problem more straightforward. We have retained earnings of 290,000, and my example is so simple that I left off additional paid-in capital. We don't. It doesn't pertain to the problem. Okay, 600, 290, total 890. Okay. Company announced a 2-for-1 stock split. Okay. The only thing that changes is the description here. Okay. The dollar amounts don't change. In the last problem on the previous page, retained earnings went down and common stock went up and additional paid-in capital went up. We actually moved money out of retained earnings. And a stock split. So why would anybody want to do a stock split? Does anybody know? Is that a good thing? Bryce?
Makes it easier for investors who can't afford something that's too expensive to buy in.
So like the stock is trading at $10,000, you split it to.
Like Google's about to do a 20-to-1 stock split, and it's like $3,000 a share right now, so now they get like 50 shares.
Exactly, yeah. And you don't always have to do 2-for-1. You can do 3-for-2. You can do anything you want in a stock split. Okay. So years ago, Starbucks used to say, if our stock selling price, not par value, selling price, stayed above $50 a share for 6 months, we'll split and go back to $25 a share. As a former math major, this just never made any sense to me. It still kind of doesn't make sense, except that I see it in action. So what happens when you stock split? In Starbucks case, they went from $50 a share to $25. So where I once had 1 share, I now have 2. So my position doesn't change. I still have 2 shares of Starbucks stock for a total of $50. But what they found in splitting was that lower price would stimulate the market and it would move up faster than it had at the higher price point. I mean, it's just math, right? It shouldn't matter, right? But somehow it does. So it moves up a little bit faster, it just sort of accelerates.
Yeah, I feel like if you could buy like fractional shares and it shouldn't really matter at the end of the day.
I know, it shouldn't matter, it's just math, right? It's just like 1 times 4, it's like counting up your sheep by counting the legs and dividing by 4, but somehow it does have some psychology effect on the market. Makes it. We're not seeing as much of that as we did like in the 90s and early 2000s, but
It's like a limited time offer.
a limited time offer, going fast.
Yeah, I think there's like a ticker like Berkshire Hathaway, which is like 6 figures a share, and they've never split.
They've never split, and they're like 50,000 a share or something.
It's like 600,000.
Okay, we need to stop. So what's the value in stock splits? The market responds, more trade, drives stock price up. Okay, all right. Okay, we're gonna stop here. You guys, if you need like a 3-minute break to run down the hall, otherwise you're gonna work with your